Welcome to Module 2, Loan Programs and Down Payment. So in this module, we're going to go over the different types of properties. We're going to go over loan programs that are available that are most of the mainstream types of loans that most people get. And we're going to touch upon down payment assistance to help you navigate as you do your research in your particular state or area. Lesson 1, Loan Programs. Before we dive into loan programs, we're going to go over loan property types. This is the key to unlock the loan programs and what's available for you. According to lenders, there's only 3 types of properties that you can qualify for different loan programs. So let's review that first. The first type of property, and the most popular, is a primary residence. This means that this is where you lay your head down at night, where you live, and it must be within a commutable distance to where your job is, or we have to prove that you're a remote employee. For example, if your job is in Ohio and you're buying a primary residence in Florida, be prepared to provide proof that your job is remote. You can't work physically and show up for a job in Ohio, but your primary residence is in Florida. So primary residence is where you lay your head down at night. The second type of property for lenders is a second home. A second home is synonymous for lenders with a vacation home. So this is a secondary home in addition to your primary. It's in a vacation type spot like the mountains, the beach. Now, there are exceptions to that. You might have a property in another state or city because you're visiting somewhere for medical treatment. I live in Houston, Texas, so we have a great medical system. Lots of people travel here from all over the world in order to seek medical treatment, cancer centers, etc. That also makes sense as a second home, vacation, second home type property. The third type of property is an investment property. This would be any type of property that's not the first two, that's not primary or not a vacation home. It doesn't mean that you necessarily rent it out, but it means that it's not one of the first two categories. It's an investment. Whether you pay the loan yourself or you have someone else pay the loan, it's an investment property for the consideration according to the lender. So now that we've defined what the 3 types of properties are, we can dive in to the actual loan programs. The first type of program that I'll mention is 45% of the loans that are out there. It's called a conventional loan. Conventional loans have some synonymous terms that as you're doing your research online, you might run into these names, so I'll mention them. A conventional loan is also called a conforming loan. It means that it's conforming to the limits or the regulations of a Fannie Mae or Freddie Mac loan. You're probably wondering, Jennifer, who are Fannie Mae and Freddie Mac? I actually jokingly with clients refer to them like the Apple iCloud. I'm like, Apple iCloud is there. You don't really know who they are. You just know that it works, right? So all joking aside, Fannie Mae and Freddie Mac are the 2 government-sponsored entities. They're not government-owned entities, but they're sponsored by the government. What these entities do is they receive subsidies from the government so that they can help make home ownership possible for a large portion of America. So conventional loans or conforming loans are governed, or the underwriting guidelines are governed by Fannie Mae and Freddie Mac. So as you hear all these terms, I just wanted to define who these players are so that you know what's what. Now, a conventional loan, we'll go over primary residence first. The primary residence on a conventional loan, if you're a first-time buyer, you're able to put as little as 3% down. If you're a second-time buyer or more, 5% down is the minimum required. Now remember, it's subject to you being able to qualify for that payment. If you're buying a second home, 10% down is the minimum. If you're buying an investment property, 20% down is the minimum that is going to be required. It's important to note that when you put less than 20% down, you'll have something called PMI, or private mortgage insurance. This is an insurance that's paid by the borrower for the lender to repay the lender in case of foreclosure. Back in the 80s, when my parents were buying houses, everybody had to put 20% down. And then some genius or some corporation came up with the idea of private mortgage insurance. Mortgage insurance was born in the 1980s as a way to cover risk for lenders to have the confidence to lend people with low down payments. So what the mortgage insurance does is it makes homeownership available for more people by letting them put down 3, 5, 10% down and not have to worry about having such a large down payment in the very beginning. The next type of loan are FHA loans. FHA stands for Federal Housing Administration. This represents approximately 25% of the loans that are done in the United States. FHA loans are sponsored by the Housing, Urban, and Development. FHA loans are considered government loans. They were created back in the 50s in order to make home ownership more attainable for more people. Now, FHA loans have limits. It depends on the county in which you live. And usually every year the limits will change and they'll usually increase because as time goes on, limits, average home prices will increase over time. So be sure to check in your county what the maximum loan amount is that might be applicable to you. FHA loans require as little as 3.5% down payment. There is a catch to FHA loans, and that is you can only have one FHA loan at a time. There are exceptions if you move out of the area because of a job, for example, you might be allowed to have 2 FHA loans. Also, if you've been divorced or you're divorcing, you also can have a secondary FHA loan. There was actually recently a situation where we were able to do an FHA loan for 2 sisters that lived together. We did a loan for them on FHA a few years ago. Now that sister and her new husband is vacating the property. We were able to actually use the exception and do a new FHA loan for the sister, and she had 2 FHA loans in her name. So be sure to check with your local lender for exceptions if that will apply in your case. Federal Housing Administration has more lenient guidelines as far as credit and debt to income ratio. This is what makes FHA loans super attractive for homeowners that are really looking to get into homeownership, get into that home of their dreams, but they might have qualifications that are stretching it on the debt to income or the credit side. So make sure again to talk to your lender to make sure if an FHA loan is right for you. To learn more about FHA, you can go to fha.gov. You can also visit my YouTube channel, and I've got lots of videos about FHA, current guidelines, and some popular questions about FHA loans. Now we'll go into another type of government loan, which is a VA loan. This is my favorite type of loan because I definitely want to do all that I can to help the veterans that have served our country. VA, the Veterans Administration, thinks that as well. VA loans offer 0% down for veterans in most cases. And again, you just need to be able to qualify for the payment according to the loan that you're trying to obtain. So 0% down, these loans have no mortgage insurance, and they're more lenient on credit score and guidelines similar to an FHA loan. Now, veterans that are disabled receive an even bigger benefit, and they won't have what's called a funding fee. So one thing that VA loans do have is a funding fee that's tacked on top of the loan. So for example, if you are a first-time user of VA benefits, there's a 3.15% fee that's called a funding fee on top of your loan. So let's say, for example, it's a $100,000 loan. Just for an example, a 3.15% fee would be $3,150 that's on top of the $100,000 loan, which means that you would be borrowing $103,150. When you're disabled, that funding fee is completely wiped out and you're just borrowing the $100,000. So VA wants to make sure they're doing all they can to support those veterans who've had hardship and are disabled. Check your county in which you're buying as well. If you have 100% disability, you're more than likely entitled to 0 property taxes in the county that you're buying. So counties are different from county to county, so make sure and check on your local authority's website. For more information about VA loans, you can visit va.gov. The third and final government type of a loan, we went over FHA, VA. The third one is called a USDA loan. That stands for U.S. Department of Agriculture. These are homes that are in rural areas that are usually always outside of the city limits. Now there's a map. So USDA, if you go to usda.gov and you search around and look for a property lookup tool, they're going to have a map with areas of USDA approved properties. Usually it'll be a color map where they'll have a shaded area that is or is not within USDA. You can also input a specific address and double check. Now, what's the benefit of a USDA loan? This also is a 0% down loan. There is a warning though. These loans are very hard to obtain and have a much stricter requirement. These loans have a 41 to 43% maximum debt to income ratio that's required because they're doing 0 down. So make sure you talk to a lender early to make sure that the area that you're looking is in a USDA area, and make sure that your debt to income ratio and your credit score are in alignment with what USDA requires. To get more information on a USDA loan, you can also visit usda.gov. Jumbo or non-conforming loans are another type of loan that are the larger loans. They are loans that are above the conforming limits that Fannie Mae and Freddie Mac have established. So that's why they're called non-conforming. They're not conforming to Fannie Mae and Freddie Mac. So every year, the Federal Housing Finance Agency, which governs the conforming loans, decides what are the average median prices of homes. A limit is established, and anything above that limit of a loan amount is considered a jumbo or a non-conforming loan. Those are synonymous terms. These loans, in most cases, require a 20% down payment. There definitely are exceptions. There are lenders out there that will loan less than 20%, but I think going in, it's good to assume that if you're in that larger loan category, which would be categorized as a jumbo loan, that you are expecting to put 20% down. Talk to the lender in your local area as you're interviewing lenders. Talk to lenders and ask them if you're in the jumbo loan category. And again, that would be a loan that's above the conforming loan limit for your area. Ask them what opportunities for lower down payment there might be with their loan programs. The last loan that we'll go over is a private or non-QM loan. I won't spend a lot of time in this section because it doesn't apply to any majority of the people. It's a very small portion of people that would get this type of a loan. But when you hear things like a bank statement loan, a no income loan, these usually fall into this category. Jennifer, what does non-QM mean? It means that it's a non-qualified mortgage. So to give you a very brief history, back in 2008, there was something called a mortgage meltdown. And there were some terms that the government created in order to regulate the mortgage industry. One of them was QM, qualified mortgage, and non-QM. So non-QM loans are loans that don't conform to a lot of the regulations that are required by lenders. So these loans are the more private, let's call them hybrid loans, where they take shortcuts on certain guidelines. Now, the offset for that is you can expect higher down payments, higher interest rates in these types of loans. So if you think that that will apply to you and you might need a no income, a bank statement, or some type of other loan that has an exception, non-QM, aka private loans, could be loans for you, and it's best to discuss this with the lenders that you're interviewing to see if they're able to offer this type of financing. This concludes lesson 1. I'll see you in lesson 2, where we're going to talk further about down payment and down payment assistance.